Well, greetings and welcome to Investment Strategy Brief for November of 2024. Well, we're finally past the U.S. election. So in this session, I want to get into the impact of the elections, basically what happened and what this might mean in D.C. for policy, et cetera. So let's jump into it first with where things landed. I think we all know now that it is unified government that we're headed towards for the Republicans, with Donald Trump decisively winning the presidential election. The Senate going a 53-47 split for Republicans, and then interestingly, the House being a very tight margin where it looks like the Republicans will gain a majority. Right now, the count is 218 seats, which is the minimum you need for a majority, but there's a few election contests still outstanding to be counted. So we'll see where that all lands. But think of it as tight majority. And so what we want to get into in a little bit of depth is basically going across different topics and talk about what the implications are given this change in D.C. that we're seeing. So let's start with deregulation. We know that the administration coming in will make it a focus to roll back some of the regulations imposed by the Biden administration. So you can think of things like a less aggressive Securities and Exchange Commission. So, for example, requiring less or perhaps no climate disclosure. Another example would be the Federal Trade Commission, the FTC, basically being a little bit more accommodative of certain mergers and acquisitions, so maybe an uptick in M&A activity as a result. Now, next up is taxes. We know just in general that the Republicans and Trump are going to lobby for lower taxes, but that's actually going to be kind of tough to do. So when you think about it first from the perspective of extending the Tax Cuts and Jobs Act of 2017, as they are set to expire next year, there's a good chance that some of that might get done, but there's no guarantee. That we know there's a focus, for example, on a softening of the cap on the local state and local tax deduction. But again, there's a lot to be seen there in terms of both that tight majority in Congress and the need sometimes for bipartisanship with Democrats. Now, one thing where we think we may see bipartisanship is sort of that popular campaign promise from both sides, really, that to eliminate taxes on tips, overtime pay, and or Social Security benefits. So we'll see how that all unfolds. But think in the neighborhood of perhaps taxes maybe staying low in terms of where they've been, but maybe not quite as clean as just extending all the tax cuts from 2017. So next up is healthcare, and we should just anticipate the healthcare sector experiencing significant change. We know that RFK Jr. has been nominated to head the Department of Health and Human Services, so imagine significant changes if that were to be the case. Now, maybe he won't be approved, but still he will have a voice and can sort of advocate for significant change. In any event, think, though, as well, an increased focus on deregulation that the Republicans believe would lead to competition and efficiency, although there will also be a focus on lowering drug prices, which, of course, could be a headwind to revenue in general. Now, next up is military and defense. We all know that President Trump advocates for a very strong military. So as it relates to military and defense spending, I'm not sure it's going to go down. But at the same time, we know that he's focused on peace. He wants to try to negotiate peace, especially in Russia, Ukraine, but potentially in Israel, with Israel and Hamas and Iran, although that'll be obviously a bit tougher. So again, I think the takeaway, though, is just to expect military and defense to be continually be supported in a financial sense. And we'll see how that unfolds. Now, speaking of foreign policy and then more broadly, we know that Trump will take an America First approach. And he'll pursue that both with China as well as U.S. allies. One of the things that everybody's talking about is essentially increased tariffs. So think significant tariff increases on China imports. But we would expect that to be followed by aggressive trade negotiations. And then when it comes to tariffs elsewhere, so think in the neighborhood area like NATO countries, basically as a mechanism, again, to send a signal, look, we want these countries to pay their quote-unquote fair share to be part of NATO. And so again, we know already that President Trump will take an aggressive approach when it comes to foreign policy. On the energy front, we know this is a bit of a reversal on what we've seen in the Biden administration. So once again, we could see President Trump pull the U.S. out of the Paris Agreement. We also can imagine the potential for the repeal of certain Environmental Protection Agency rules. And then finally, a shift, right? A focus away from alternative energy like wind and solar back towards oil and gas. So imagine things like increased drilling. And also, honestly, we also believe that there will be an increased focus on nuclear energy as a solution. Now, when it comes to monetary policy and the Fed, we all know that President Trump is very aggressive in his sort of public communication about what the Fed should do. And so he's taken a bit of heat about that. But at the end of the day, we know that that's a practice that we've seen historically. So we know Clinton and Obama had regular meetings with the Fed chair. We know Nixon sort of critiqued and pressured the Fed chair in place when he was in office. We know Carter and Ford clashed with Fed chairs. So it's kind of a tradition. But at the end of the day, what we believe strongly is that the Fed will maintain its independence going forward. So while we expect President Trump to be vocal about it, we don't expect that to necessarily influence policy in a significant way. Now, taking a step back and looking at government spending, we know that there will be a focus on efficiency. In fact, President Trump has nominated Elon Musk and Vivek Ramaswamy to co-lead a newly formed department, the Department of Government Efficiency. Basically, the idea is to reduce bureaucracy, cut unnecessary regulations, and restructure agencies to eliminate waste. And so he's given them a window of time. So I think July of 2026 is when he wants sort of the report back on what should be done. And this, for all the criticism it has gotten or will get, at the end of the day, it could well result in some kind of reduction in spending. Now, you couple that with the idea that we don't anticipate significant bipartisan fiscal stimulus legislation. That means we probably see a decline in spending to some degree. And that's helpful when it comes to our deficit and the fiscal trajectory that we've been on. Now, taking a step back more broadly, all of this has led to a general uptick in animal spirits, meaning that investors net have been positive initially to the elections, maybe in part because it was so clear who won and it wasn't going to get contested. People are probably kind of spooked about that. And so what we saw was an immediate positive reaction. I think especially in the area of financials and for example, regional banks. But it's backed off a little bit as people are interpreting these policies. And for example, the proposed cabinet leaders, sort of the leadership that Trump is putting in place. And so, or wanting to put in place, obviously subject to approval. So we should, in fact, expect a little bit of volatility going forward. We'll get into valuation in a second. But in fact, if we take a quick look at the VIX index, what we saw was, it bumping around through the last bit of time and sort of jumping back up a little bit as we headed into the election. So this dotted line basically shows you election day, and you can see after the election really fell quite significantly again, given the clarity of the result, I think. And then just recently, as people start processing everything, it's kicked up just a little bit. So again, more to come when it comes to the influence of these policies and where we're headed on the markets. To take a step back, let's just quickly review where we've come from here in 2024, and noting that, for example, artificial intelligence, as we've seen woven through our long-term themes, has sort of been a foundation of optimism in 2024. And that's in part, as we look across sectors and industries, a lot of different applications. So sort of little glimpses of the future when it comes to what AI might be able to do for us as it relates to running businesses and sort of living our lives. And so, again, there's just been this undercurrent of optimism that's translated at some level to a better than expected economic environment. So think in terms of the economy growing above trend and growing a bit faster than consensus expectation. And that is shown by this chart, which we look at a lot. This big blue box is the consumer consumption. And so over 2/3 of the economy, basically, if the consumer is feeling good, then the economy is doing okay. And so what we've seen is when we look, for example, here on page 12 at the sort of quotes from, these are basically from earnings calls. And what we've seen is a buildup again of the green boxes, meaning the more positive comments from companies that face off with the individual retail consumer. And so the consumer has been holding up. Now, we do know that that's translated in retail sales, which have bumped back up above longer-term trend. We know that's done a little bit from borrowing, meaning that debt's up a little bit, but importantly, therefore, as well, the cost of debt is up, and we've seen a slight uptick in delinquencies. So we're seeing, at the end of the day, still a few little cracks in the consumer. We know confidence has sort of been interesting in the sense that people have been generally okay with the present, but worried about the future. And of course, one of the things that has been frustrating for folks and is in focus for the Fed is inflation. And so when we look at our monthly kind of snapshot of the consumer price index and producer price index, what we've seen is a little bit of a firming in those two series that has the Fed's attention. And in fact, when you think about it from the perspective of the Fed cutting rates, inflation's ticked up just a little bit. The economy's held firm and strong. And then there's the uncertainty of the next administration that if, in fact, it is a sort of a bump to the economy, that's probably, sort of an upward force on inflation. So the Fed overall is sort of shifting to a little bit of a cautious stance. And in fact, when we look at the Fed futures on where the expected funds rate is headed, right out of that September half-point cut, this blue line represents the markets expecting the Fed just to keep going and cut rates a lot. And by the way, they did cut another quarter point at their last meeting. But, since then, those futures forecasts have risen a good amount. And in fact, as of this morning, was almost, not quite, but almost a 40% probability of no action in December. So the Fed is definitely talking up, wanting to go slow, wanting to make sure everything's okay. And they feel sort of emboldened to do that because the economy's held up pretty well. Now, we know this is all sort of against a backdrop of a high rate environment. We've talked about this before, the idea that essentially the cost of servicing our debt now represents over 1/3 of our discretionary spending. And in this chart, an update would be two things. One is the level of the 10-year has risen a little bit, right? So that's sort of in anticipation potentially of a little bit higher inflation. That's an anticipation of a little bit sort of firmer economic growth given the shift from the election, but also candidly, potentially the worry about the federal debt. And in fact, while last time we showed just quotes from corporate leaders, I made the point of bringing in a quote from Chairman Jay Powell from the Fed in his last press conference, where he was kind of pushed by a reporter on where we're headed in terms of the fiscal trajectory. And he finally came out and basically said, well, the punchline is, this isn't sustainable over time. And so it's not the Fed's job to fix it, but it needs to be fixed. That was kind of the message. And so that's another example where we're going to expect to see corporate and political leaders start to focus in on the deficit and the debt with a goal basically of reining things in a little bit. So again, that ties back to that idea of spending reduction in the government. And, we'll see where taxes go. But to the degree we can see a decline in the deficit, that will be a good thing. Now, overall, therefore, the economy is expected to grow at 2.7% this year, falling to just below trend next year, but still positive, right? And so this has just been a better than expected environment and a forecast as we look into 2025 for more of that. Now, when we turn to the markets, as I mentioned earlier, interest rates are up a little bit. So when it comes to fixed income, those attractive forward-looking yields have even risen a little higher than where we've looked at before. But like the VIX, there's another index on the bond side called the MOVE index, which captures, I think of it as both a combination of the interest rate volatility, how are rates moving around, as well as bond price volatility and sort of the volatility of the bond market overall. And so the bottom line is that interest rates And the bond market is a little more volatile than normal. But again, right now, the yields look attractive. Now, when it comes to the equity market, as we look at it each time, the markets remain overvalued. So a 26% premium based on PE valuation to the 10-year average. So markets are richly valued. You recall that we've talked about that from the perspective of the dominance of the Magnificent Seven. That's really been driven by their earnings growth, which the forecasts still are very positive for their earnings growth. And yet when we adjust essentially the PE for that earnings growth and get that PEG ratio, what you can see is just incrementally, the Mag 7 is now maybe a little bit more overvalued than the rest of the market. And so, again, these are signals that the market's a little bit richly valued. And we are seeing sort of the idea of the markets broadening out. So think in the areas of healthcare and industrials and materials, in addition to tech, basically an anticipation of solid earnings growth next year, which is supportive of the market going forward. In any event, here's a chart that we like to show each month, and we've added a new column, right? The one on the far right is since the election. So you can see that the general stock market is up just a little bit, but importantly, financials are up almost 7%. And when we look at the KBW Regional Banking Index, for example, up over 11%. And this is all through Friday, November 15th from that election day. So think a week and a half. And so, the bottom line is the markets have held up pretty well and responded overall positively to the election. Now, this idea of sort of rich valuations means that equity investors and the equity markets overall will sort of project a sense of some sensitivity to bad news, for example. So the kinds of headwinds we're watching, of course, are escalating tensions in the Middle East, the prolonged and maybe escalating war, Russia-Ukraine. We see the risk of reigniting inflation with that slight firming we mentioned. We see the risk of an unexpected slowdown in the economy. And by the way, we're seeing that happen a little bit around the world with China and Germany, as we've talked about before. And then that fiscal trajectory, which at the heart of it is sort of the strength of the U.S. is a foundation to our global system. And so the idea that there would be a weakening confidence in the U.S. dollar or U.S. debt can really have some reverberation. So we're not, again, immediately worried about that, but these are some of the headwinds that we continue to focus on, as we've talked about before. Now, looking forward, just to close out, as ever, there's so much to still process. We've got really an active, roughly a month and a week or so to finish out 2024. We've got employment data. We've got more consumer sentiment data, inflation data. We have one more Fed meeting, so we'll learn a bit from the Fed. We'll have more in terms of retail sales, so where the consumer is headed, et cetera. And then we'll roll our way into 2025. We're hard at work right now on our outlook for next year, so more to come on that. But I'll just sort of close out, as I always do, with an invitation to check out stifelinsights.com. You'll see this video, a podcast related to this, the slides you can get for this presentation, but then importantly, a broader body of work that we make available for our clients. And so thank you, anyway, so much for listening to this November session, and we'll look forward to seeing you in December for the last one of 2024. Thanks so much.